Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and today I want to speak to you about the changes from the government and the opportunities that we're seeing in the market right now for you as an investor to take advantage of. Because if you sit there and just listen to the noise, which is the media and the people at the barbecues and anybody else that hasn't really got any experience in property development, they just listen to the news and they love to start fear-mongering everybody, then you're going to get pulled down to their level, right? And the way to get through that is to surround yourself with people or listen to people that are out there doing deals on a daily basis for themselves, for the clients, whether that's me or whether that's any of the other professionals in this space, because these are the people that are going to see the opportunities, and these are the people that are going to take advantage, and these are the people that are going to win long term as well. And then you can take action on that as well. And if you listen to this podcast right at the very end, I've got an offer for you that you might want to take advantage of. So firstly, let's talk about the changes that have been proposed from government. And I'll put proposed in inverted brackets because they are proposed changes. They have not been legislated yet. They have not been passed by Senate yet. So they are just proposed changes. Now, if they do come into effect, then it's obviously going to change the way that us as property investors need to think about how we do things. The traditional buy an established property in a high growth area, hold it for a certain period of time, take advantage of negative gearing benefits, and then sell and pay 50% capital gains tax. That could change. And also negative gearing against established properties has been removed from the budget night, which was the 12th of May 2026. So if you purchased a property or even contracted on a property after the 12th of May, you would not get the negative gearing benefits on that established property. Now, they have still said that new builds can get negative gearing benefits, and they've also said that new builds can get the capital gains tax exemption at 50%. So essentially, the government is saying, stop buying established properties and start building new properties for us. A, because we need more housing, but B, because the government makes so much more money every time you build a property. The amount of laid into a new house build is absolutely crazy. Think about stamp duty, GST on the build, tax everywhere, the amount of people required to build these properties, and the government's just got the hand out every single time taking tax from these people. So they want you to build more housing, right? Naturally, this is going to push a lot of people to the outskirts, the urban fringe sort of areas, and continue with the urban sprawl, which is a problem in Perth because we are flat and we are spread far and wide from Alkimos or Two Rocks in the north right down to Mandurah or even further in the south. And then we're kind of sanctioned by the mountains when you get to places like Forestfield. But then when you start looking up towards Bullsbrook, we can continue to push up in them areas. And we're just going to keep spreading and spreading further out. The problem with that is we need more schools, we need more hospitals, we need more roads, we need all of these things that the government will put in for us, but they use taxpayer money to put these things in, right? So naturally, a lot of investors now are going to go from established properties to new build properties so that they can A, still invest, and B, still get access to negative gearing benefits and still get access to the 50% capital gains tax discount when they sell that property in the future. If you're an investor and you buy the same stuff as everybody else, you're going to get the same results as everybody else. And growth is limited on these fringe suburbs anyway, because not a lot of people want to live there. They're only living there right now because these are the only places available to purchase because the market is so stagnant in Perth right now. But the biggest opportunity that we're seeing right now, and the reason before I tell you what that is, if you think about it, established properties, they've removed negative gearing. If you buy an established property, you cannot offset that against your salary anymore and the traditional negative gearing, if you want to call it a benefit. The other side of that is you can still offset the negative gearing from a negatively geared property against the positive gearing from a positively geared property. Now, you're probably going to start and put two and two together here and understand what I'm trying to tell you. If you continue to do fringe new build houses, Yes, you're going to bring more supply to the market. Yes, you're going to have an investment property, but you're going to be negative geared and your growth is going to be limited, if any at all. If you do an infill development, and where we're seeing the biggest shift now, or the biggest opportunities right now, is a simple 1:2 subdivision. You buy an established property on a block big enough to be subdivided from 1:2. And then on that back block, you build a 6-bedroom HMO, or if it's big enough, you can build an 8-bedder with a 6-bedder with a granny flat. And you can use the positive cash flow from your new build property to offset the negative cash flow on your negative geared property, the established property. So now you've got 2 properties, you've manufactured growth because you've bought a property, you've subdivided it, you've got 2 new titles, you've then built another house in it, so you've got equity uplift across the 2 new dwellings, or the 1 new dwelling, the 1 old dwelling. And then more importantly, you've got a cash flow positive and a cash flow negative property, and you're going to offset that loss with a gain. And then you're probably going to end up with 2 properties that are neutrally geared in an area that nobody else is providing rental stock. And they're not going to be providing rental stock in them areas because if they buy an established property, they're not going to get the negative gearing benefits. So this is where we are seeing the opportunity in the market right now. And I'm going to tell you more about how you can look for these deals in a second. Well, firstly, let's talk about the vacancy rate, or the market right now in Perth, because on the last episode, we had Jamie von Virgil in from CBRE. He's a state director for Western Australia, and he's got 20 odd real estate valuers that work underneath him. And we spoke about the sentiment on his team. We spoke about the questionnaire that they send out to all their valuers to get the feedback from them and what they think's happening in the market. And sentiment is one thing, but data is another thing. And even though people are feeling like the market is going to turn or slow down, when you look at the fundamentals of supply and demand, we still have a chronically undersupplied market. We still have mass migration moving to not only Western Australia, but the country in general. And we still can't build houses fast enough to keep up with demand, right? So we've got a supply and demand swing with too much demand, not enough supply. What Jamie said on the podcast was that annual rent growth, even the quarter just gone, we had over 4% in the quarter, and the annual rent growth for Western Australia, 6.7%, which is equally top nationally with Brisbane. So Brisbane's getting a lot of attraction right now because of the Olympic Games, and a lot of people are piling into there thinking that that's going to drive prices up, which it will. But then what happens after the Olympic Games? The median house price in Perth at the end of 2025 was $840,000. And REWA said that at the start of the year that we're going to see 10% capital growth in 2026 and 15 to 20% for units. Now, so far, I know I said 6.7%, but I believe we've seen over 8% capital growth in Perth right now. So I think we're going to see more than 10%, unless what Jamie says with the market should flatline. He's expecting it to either be neutral or very limited growth over the next 3 to 6 months. And that will be determined by interest rate increases, which the RBA are saying that they could be 2 to 3 more increases this year, and also with the proposed changes from the market, right? And the reason that could potentially slow the market down is because the markets are driven by 2 very strong emotions, which are fear and greed. And when people are fearful, they freeze, they stop, they sit on the fence. And when people are greedy, they get involved and they start buying properties, right? And Warren Buffett says, observe the masses and do the opposite. So while everyone else is freezing, we're out there buying more and more properties for ourselves and our clients, which are wanting to continue investing. Perth since 2020 has risen over 94% median house price, which is just staggering. Again, we've seen other suburbs right around Perth, which have seen more than 94%. Some of them are up 150. And WA's population has passed 3 million. We've had the fastest growth rate in the country for many, many years now. The other problem that we've got when we go back to supply and demand is the Housing Accord target, which is the government saying that they wanted to build 1.2 million homes by June 2029. We're already tracking a year behind schedule. So again, to build more houses, we need more people. To get more people, we need more migration. If we have more migration, we need more houses. And it's a chicken or the egg scenario. Which one comes first? Do we bring the people in to build the houses, which we need to do? But when we bring them in, where do they live? Because there's no houses to live in. So we're seeing, again, a big opportunity in areas that a lot of people will now stop looking at because they don't see the opportunity. They don't see the value. And that's because they're inexperienced when it comes to property development. And something as simple as a 1:2 subdivision could net you a couple of $100,000 in equity, and you could have two properties which are neutrally geared, and then you just sit them there, rent them out, and you don't have to think about them for the next 10 or 20 years. So one thing to discuss before I get into the opportunity that I have for you is the short, medium, and long-term market that I see. This is my personal opinion. I'm open to being wrong. Again, everybody's got opinions. So what I see in the short term is investor hesitation and confusion. That's right now. People are confused. People are sitting on the fence. People are pulling back. We're seeing less competition for good sites right now because, again, people don't understand the rules of the game and people are trying to unpack everything. And that means for a long term in Perth as well, we've seen that the simple 1 to 2 subdivisions, no one's been buying them because no one can make them stack up financially. But we've been buying them because, again, we're not developing for a margin on development from a lending standpoint, where you generally need 10 to 12% margin on development to get funding from the bank. We're subdividing, we're building, we're holding, we're building equity, and we're getting cash flow from our properties as well. So whilst we've been doing that, I also see established properties softening slightly right across the country. And the reason for that is investors are going to pull back. It's only going to leave us with owner-occupiers in the market until people get used to the new normal. And the term new norm gets thrown around quite a bit. Think about the petrol station. When petrol goes up, at first people get freak out and they go, I'm not paying $2.20 or $2.30 for that. Then all of a sudden you're just there filling your car up because it becomes the new normal. I believe people will adapt once they get past the fear and the uncertainty that's in the market right now. People will adapt. People will again start to invest, but not as aggressively as what they have done in the past. It will wipe out a lot of traditional mum and dad investors, and it will bring a lot more sophisticated investors into the market as well. And that could be your typically the rich get richer and the poor get poorer type thing, because the people with capital and that can absorb that additional cash flow loss because negative gearing's gone, they're the people that will buy established properties in infill locations. And because there's a lack of established properties to rent in them locations, yields will be very attractive. And all of a sudden, you'll be getting 5, 6, 7% yields in locations where you're currently only getting 3 or 4%. So that's what I start seeing in the short term. Medium term, two-tier investor market becomes visible and permanent. This is where we're talking about the mum and dad investors and the sophisticated investors, or even the institutional investors. And when you think of I look at what's going on in the UK right now, you've got banks which are becoming the biggest landlords in the country. Barclays Bank and TSB are buying portfolios of properties right now from investors, and then they're leasing them back to the government on a fixed 5 or 6% yield. And that could happen here. That could happen. If you think about where all the money is, it's in the banks. If the banks aren't lending money out, which is their main source of generating income, you deposit your wages into the bank, they lend your money out and charge somebody an interest rate for lending that money out. If there's not as many investors in the market, then the banks will start stepping in, and I believe banks will start buying properties and banks will start becoming landlords. Now, think about our model, the HMO model. Would the bank rather have a 3 or 4% yield, or would they rather have a 9, 10, 11% yield? Again, I think whilst the HMO model, the rooming house model, is still in its infancy compared to other parts around the world, I still think the banks are going to see this as a very attractive option, and they're going to start snapping portfolios of properties up very, very soon. I also see rental demand elevated in the medium term because there's going to be less investors in the market, which means that if there's less properties on the market for people to rent, it means that they're going to be coming in more aggressively because they're going to get FOMO. They're going to miss out on opportunities because people are going to start putting $50, $100, $150 more a week to rent them properties. And then that's going to continue to drive yields up, which could bring investors back into that kind of infill location. And I still see Perth, and we're talking medium term here from like 25 to 26. I still see Perth being the highest performing state in the country. I think Darwin will just run and then drop off as soon as it becomes unaffordable, which is going to be very soon. And I see Perth and Brisbane being the two markets that people are looking at. Then long term, and again, I could be wrong in the long term, but supply and demand story hasn't changed. I still see construction constraints, labour shortages and planning delays. And the reason being for this is because a lot of people are going to turn to new builds now in an industry which is already under immense stress. We're not developing land fast enough. There's no titled land available right now in Perth. It's very, very difficult to get hold of. And then you've got to find a builder that can still build fast enough once you've got that land titled as well. So I see labour issues, I see construction issues, and I think the people that do get in there and enter into a build contract, yes, you might see 6 to 12 months of frustration, which is what we all seen during COVID, right? We had a lot of slow build times here in the West. But the people that went through that frustration period are the ones that are now sitting happy because the properties are finished, they're tenanted, and they're getting some really good returns on them properties as well. So don't let the potential issues, I suppose, or the potential bottlenecks or the potential delays stop you from investing and generating wealth. You might just have to grin and bear it, knuckle down, just accept the fact that it's going to be slow and clunky and could drag on a little bit longer. But property is a long-term game. You're not just investing for 1 year, 2 years or 5 years. You should be looking at 10 and 20 years time. So if it takes 6 months longer to build a property that you're going to hold for 20 years, it's kind of irrelevant in my eyes. Lastly, I just see our model becoming more and more prevalent in the market as more and more people look for cash flow positive properties. Ever since the proposed budget changes came out, the phone has just been red hot. We've had record inquiries through the company again and literally just can't keep up with them all at the minute. And we are expanding our operations into Melbourne. I literally just got back from Melbourne yesterday. We went over there to look for some blocks of land for 3 of our clients. I'm going to pick up a block myself. And we also met with some builders to work out how we're going to work together in that space too as well. So Melbourne's back on. We also looked at some established properties and met with some guys that were doing some conversions over there, which was really good to see. And we are going to open up the established conversion market again for both Perth and Melbourne as well. So if you are looking to work with us, you can do Perth, Melbourne, you can do new builds, you can do conversions. And alternatively, on the flip side of this, if you don't want us to do the work for you, then I've got something that you can potentially get access to yourself if you just want to learn how to do these things. And it's called the Cashflow Academy. And the Cashflow Academy was a kind of download from me into a online portal, which is 12 modules currently. Everything from what is core living and treating your investing like a business, structuring yourself correctly, how to do rent to rent and no money down deals, joint venture deals, how to find established properties and convert them into HMOs, how to do the property management yourself if you want to do the property management yourself. And now with the changes from the government, I'm also going to record a module on subdivisions, new build construction and renovating standard properties so that you can build up your equity base big enough so that you can then transition into a HMO in the future as well. So if you want access to the Cashflow Academy, it's $3,995 for the month of June only, and then it's going to increase to $4,995 because I'm going to release the new modules in July, and then in August it's going to increase to $5,995 because I'm then going to start doing fortnightly lives into the community. And if you've got a deal that you're stuck with, if you've got it could be anything, subdivision deal, it can be a new build, it can be a conversion. It can be the fact that you don't know how to structure yourself or you're trying to raise capital from a joint venture partner. Bring that to the table. And every 2 weeks, I'm going to go through people's deals and I'm going to help them understand the mechanics and the dynamics of what they're trying to achieve and help them on their way through there as well. Now, that would normally be a mastermind style approach where you'd pay a lot more money than what I'm offering the Cashflow Academy for. But we believe in, for the people that don't want to work direct with us and want to do it themselves as well, then you can get access to the academy and you can go out there and you can do all this yourself. Which then leads me nicely on to treating your investing like a business. Now, the government have proposed that the distributions from a discretionary trust are now going to be taxed at 30%. And if the old rules used to be, and a lot of my property investments and a lot of our clients' property investments was a corporate trustee, which is a PTY Ltd, as trustee for a discretionary trust. And a discretionary trust has traditionally been just a pass-through vehicle for profit. So we put all of our properties in individual trusts. We put our developments in individual trusts. And at the end of every year, we distribute that profit from each of those trusts into what we call the bucket company. That bucket company would pay tax at 25%. And then you could then use that money that was remaining after you paid the tax to then distribute out to different trust structures, or you can pay yourself a dividend out of that as well. Government have moved the goalposts a little bit, and we are still not clear on exactly how you should be structuring yourself yet. And the only reason that we're not 100% clear on it is because the changes that they're proposing are only proposed. They're not yet legislated. So as it stands, I am going to be contracting on a block of land in Melbourne. I'm still going to be using the same entity structure that I've been using for all my other investments, because the government have also said that there's going to be a grace period where you can change your entity structures. Now, there could be some other complications with that as well. And what that means is if you've got a discretionary trust with a corporate trustee, you could change that to a fixed unit trust, for instance, or you could just change that to a PTY LTD. That could trigger stamp duty in some states, and we're still not clear on exactly how that's going to work. But that should still not stop you from treating your property investing like a business, right? Because now the negative gearing's gone. If you're doing renovation flips, if you're doing developments, if you're doing HMO, rooming house, whatever, you should still be treating it like a business. I'd never run a business in my own name, and neither would many of the business owners that I've met before. So just a word of warning again, if you're about to invest in a property, sit down with your accountant and say to them, I'm going to buy this property. This is what the numbers look like on it. What is the best way to structure myself to minimize my tax effectively and also protect my assets as well? If you've already got an accountant, great. If you've got a broker, have a chat with them as well. And there we go. Don't forget, whilst people are still sitting on the fence right now, people are still earning money, right? People will always look for places to put their money for investment, because you cannot save your way to wealth. You are always going to have to find some form of investment vehicle to put your disposable cash into. And then that growth vehicle, that investment vehicle, has got to grow substantially for you to then build wealth so that you can retire early and live life on your terms and make the rest of your life the best of your life. So whilst people might be hesitant now, whilst people might be sitting on the fence right now, and whilst people might be scared to move, this will pass. That's all I can say. I've been in this country 16 years. I've seen so many changes, APRA stepping in, bank policy changing. Even in the HMO space, we've changed change after change after change from the bank policy and the lending policy. But one thing for certain is the market continues to move in the direction that we need it to, right? People always need shelter. People always need somewhere to live. And right now we don't have enough housing for all the people in the country. So hopefully today's been helpful for you. Hopefully, if you want to look into the 1 and 2 subdivision stuff and do that yourself, I wish you all the best. And if you want some help with that, then the Academy could be for you. But my name is Neil Gibb, and I'll see you next time on the HMO Property Show.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.